Okay, hi there everyone and welcome into tonight's session. It feels like it's been a bit of an age since we've done one of these. It's the first one for 2022, so absolutely. Welcome into the new year everyone. If I haven't said Happy New Year yet, obviously I haven't, so Happy New Year. And tonight's session we're going to talk quite a bit about value stocks. And the reason why obviously we're going down the path of talking about value stocks is because that's what we believe is going to perform really well in our market over the next 12 months to 24 months. So hence the topic. Now, just waiting a little bit more. I still see a lot of people logging on, so we give it a few minutes. Make sure you go get yourselves nice and comfortable, get yourselves a drink, get a nice scotch or a wine or something, get you kick back and listen to us tonight. Session will probably go for anywhere between 45 minutes to maybe an hour. Yep. A bit of content to go through with you guys that should help you out with your investment decisions this year. All right. I think the numbers are starting to settle down now. It's a sort of big influx of numbers ticking up. So I just wanted to make sure everyone was on before we got started. Okay, let's get into it, guys. So basically, before I go any further, I just have to remind you that any advice contained within this presentation is general only, so it doesn't consider your personal circumstances or objectives, okay? And you need to consider yourself whether this information in this webcast tonight is appropriate to you. The information here is for educational purposes only, okay? So don't go rushing out and just jumping into a bunch of investments on the back of what we're saying. Make sure that it is suitable for your investment style. Okay, so a little bit about who we are. Okay, so there's two main brands that we run here. One is Emerald Financial, and that's who you're hearing from tonight. The other brand is Trader Circle. Emerald Financial was really born by the advisor in Trader Circle. So Trader Circle has been around for 16, 17 years now. Trader Circle was designed to help support people that want to learn how to trade the market more from a short-term perspective. So derivatives focus, leverage focus, that sort of thing. We saw sort of an opportunity for us to sort of also get into the investment side of things. All the advisors on the desk, we all have investment portfolios. We're all sitting here every single day looking for ideas from a longer term perspective as well. So we decided to go down that path, and that's where Emerald Financial was born. So Emerald Financial, what we do on that side of the fence is more longer term investing. So we're looking for, ideas that are going to last for a few months, maybe a few years, that sort of thing. We look more fundamentally rather than technically. And we build a bunch of tools inside a subscription to help people that are trying to build their own portfolio to find great ideas and save you a bunch of time in doing your research yourself, okay? Because let's face it, researching 20 stocks to find the best one can take a lot of time, and most of us are pretty time poor these days. So that's what Emerald Financial is all about, okay? Our subscription's there to help people build an investment portfolio over time and help you manage that. We do that in a number of ways. So that's the two brands, okay? Also, the two people are talking tonight. I've got Sam Green beside me here.
Hi, guys.
He's our main equity analyst, okay? He is brilliant, okay? He doesn't just do equities, he does derivatives as well. He knows a lot about the Australian and US markets. He's a wealth of knowledge. I'm constantly asking him questions about various different stocks and what his opinion is. He's the first person I'll go to for an opinion on a stock, okay? So you're in good hands tonight. I will leave you with Sam to go through his view on value stocks and what's happening in the market tonight. Myself, my name's Tim. I've been in Trader Circle for quite some time, almost the same amount of time as Sam. I think we're heading into almost 10 years, aren't we?
Yeah, we are.
Right? So we've been on this desk for quite some time, guys, right? So as a whole, I think there's about 6 of us on the trading desk, guys, with different levels of experience, ranging from 10 years right up to 40 years, right? So it's a pretty broad desk with a lot of knowledge. Okay, so I will pass you across to Sam now. He's going to talk a bit about what's happening in markets right now and our view coming up at the moment. And then I'll jump on a little bit later and talk about what's been happening in our recommendations and things like that. So I'll leave you with Sam.
Fantastic. All right, guys, you're mine now. And it's fantastic to have you all here. So thank you very much, and thanks for joining us in this. And I guess we're entering a pretty interesting year for equity markets. 2022 will be one of the more unique years that I think we've experienced for some time. It certainly kicked off with a bang. You only have to look at the volatility that stock markets experienced through January to see that something is happening. We're going through an inflection in markets. And if you basically look at our market across the start of 2022, we've now held up rather well. US markets, the S&P 500 being their best stock average, or at least for the large caps, that's come off a little bit. And then their tech-heavy NASDAQ index, or their growth-focused index, has really come off quite a lot and stayed fairly low. So we're moving into an interesting period. This is a time where we don't believe that the pipe dream stocks are going to do particularly well. The stuff that you're getting spooked on Facebook, the stuff that you're being told about in an email send with a rocket ship emoji, is not the sort of stock that we think is going to do well in 2022. And I'm going to touch on why that's the case, and I'm going to touch on some historical examples, and we'll go from there. So the real reason these growth stocks are not the stocks to look at in 2022, and the reason I'm here today to talk about value stocks, is because we've seen a prolonged spike in US inflation data. If we look at the bars over on the right-hand side of this chart, you'll see that consistently, month on month, US consumer price growth has been fairly elevated. Now, this is one measure of inflation, or one measure of price increases. And if you have short bouts of price increases, that's okay, especially when it's coming off a low base. But if you have a sustained period of price increases, that's when you start to worry if these increases are going to cause economic damage, and and often social damage. Often the biggest cost of inflation is the social cost, where especially the poorer people in society struggle to pay for regular goods, and their quality of life goes down. So it's definitely something that needs to be addressed. And how do you deal with rapidly rising prices? Well, the conventional wisdom says that you have to lift interest rates. You have to lift borrowing costs. We'll touch on that a bit as well. So this is the most recent US inflation data. This is their inflation data for the month of January. Well, technically it's actually the last 6 months of data, but the month of January is in the last column. And if you add up all the prior 12 months, you get to a level of price growth of 7.5%. That means that essentially on an unadjusted basis, prices across a whole range of things on average are 7.5% higher. That means that if your take-home pay is the same, you could potentially be buying 7.5% less volume of stuff. Or everything that you'd usually buy would be on average 7.5% more. Now, when talking about inflation, the conventional wisdom is that this is because the economy is running real hot. There's so much money out there. People are spending so much. There's so much excess demand that on a supply and demand curve, it's pushing prices up. For those of you who have ever looked at the supply and demand graph, the further up demand goes, the further up prices should go. However, if you actually drill a bit deeper into the numbers, it's a little more complex than that. And I suggest that you turn your attention to the columns over on the right-hand side here for things like energy services, and vehicles. And you can see that the cost of these goods has gone up an awful lot, or goods and services has gone up an awful lot, and that they're driving the average price increases a lot higher. If you look, energy costs across the last 12 months have gone up 27% on average. The cost of used vehicles in the US has gone up 40% on average. Now, if the cost of energy has gone up 27%, is that because there's a huge spike in energy demand? Well, not necessarily. We know, historically that energy has been more prone to supply-based price movements. And, I suspect that this is a big impact of the prolonged period of lower prices in energy. We've got a base effect, so rising from a very low price, it has a very high percentage gain. And also we've had lower capital investment due to those previously low prices, meaning that supply is now a bit constrained. Secondly, with used vehicles and new vehicles, it's also, I believe, because predominantly of supply factors. It's been more difficult to get new vehicles. People have turned to used vehicles because new vehicles have been rarer. And as a result, the price of those used vehicles has also gone up strongly. So I think rather than it being a pure demand story, there's actually a lot more of an inflation story involved in the US. Much more of a supply story involved in the US inflation data. And that supply story won't be addressed by rising interest rates. You can't increase supply on, or it's unlikely that you'll increase supply on something by lifting interest rates. That's my personal belief. I think the US central bank, their Federal Reserve, is actually playing a very dangerous game by lifting interest rates, when I imagine a lot of these price increases will be naturally smoothed out. But regardless, they will lift interest rates. They are going to lift interest rates, and it will have some effect on price gains. Now, we know they're going to lift interest rates because if you actually look at US bond markets, the US bond markets are telling the Federal Reserve to lift interest rates. If you look at this gold line here, that's the US 2-year Treasury yield, and the blue line is effectively their official interest rate, or it's analogous to their official interest rate. And by looking at the comparison between these two, we basically can see that the Federal Reserve policy essentially follows the markets, what the market expects them to do. So rather than the Fed really telling the market what policy is, instead they follow the expectation of the market. And we can look back at the last tightening cycle, going into the start of 2016. 2016 to 2018 was when they last lifted interest rates. We're actually going to touch on that in a little bit, but you can see that beforehand, the US funding market, or the US bond market, told the Federal Reserve to start lifting interest rates, and lift they did. If it was purely a Federal Reserve decision, there would be times where the bond market got it wrong, but if you look across the last 20 years, they've never been wrong. They've never been wrong. So rather than the Fed or the US monetary policy creators dictating to the market what policy is, instead the market really largely dictates to the Fed what policy should be. It's gotten to the point where some people believe the Fed might not even be needed, but that's another conversation. I want to draw your attention to this period here. This is, the last sort of 6 months of movements in the US 2-year Treasury. And that's basically telling us that, the bond market thinks US interest rates are going to, around 2%, and possibly to go higher. So this is basically what we're going to start see happening over the next 2 years. The expectation is that they're going to kick it off in March. So we're going to see most likely the first rate rise since 2018 in March. And it's possibly going to be a 0.5% rate rise. So a shock and awe double rate rise. Following on from that, there's various views for the rest of the year. Some people are saying up to 7 rate rises. Some people are saying 5. So 5 to 7 rate rises for the rest of the year. Why is this important? Well, it'll have huge ramifications over just about every other financial market. And we're going to talk about how it might affect equity markets a little bit. How we might sort of assume it'll affect equity markets is based on prior history. So you can go back in time and you can look at periods where interest rates have been lifted, and you can look at how that's affected different things. The most relevant period that we have to look at is the period of 2016 to 2018. This is the only time in the post-GFC world where interest rates have been lifted, where monetary policy has gone through a tightening cycle in the US. and by extension in most of the Western world. So this period is probably the most relevant period to look at for clues on how 2022 and 2023 are going to look from a stock market perspective. You can then also go back and look pre-GFC, but things were a little bit different then. Monetary policy was certainly a lot different in terms of how it was implemented, and relative borrowing levels were a lot lower. They were a lot lower. For example, the US federal government owes about $240,000 US per taxpayer. That number was a lot lower in the pre-GFC world. And so, interest rates could go higher because it was serviceable. But debt levels a lot higher now. It gets to a certain point where it's just unfeasible to lift rates further. All right, so let's focus on this period of 2016 to 2018. Really, they lifted interest rates from just before the start of 2016 to just before the start of 2019. So a 2-year period, and it was a pretty interesting period for markets. And after that prolonged period of lifting, we then saw a bit of a decline in rates. And you could say, well, there was the COVID period, but rates were actually declining a little bit before that. They were declining a bit before that. So this is the most relevant period for what's going to happen next for financial markets. This is the closest blueprint that we'll have, the closest approximation to what we're going to see in the next 12 to 24 months. Now, the first thing I looked at when going back and checking this was the effect of the rate rises on value stocks versus growth stocks. This bar chart here with the green and red bars, that is actually the US growth index. This is comprised of growth stocks. And this purple line chart here is the US value index that is comprised of value stocks. Now, I guess the traditional distinction of, value investing or value stock, if you go back and look at the sort of, early 20th century literature, is simply a stock whose inherent value is trading at less than their price. These days, it's taken on, a lot more of a connotation to mean, a low price to earnings, high dividend yield, high rate of return. It's taken on a lot more rigid terminology and rigid rules to determine a value stock. But put simply, we're looking for stocks that trade at cheap levels, stocks that trade at a very low price relative to the inherent value of the business. Now, a growth stock is something a bit different. A growth stock is a stock that trades on future potential. It trades on growth. It trades on, rather than a low value today, it trades on a low value relative to its future value. Now, why might a growth stock underperform during a time of monetary policy tightening or during a time of interest rate rises? Well, there's a two-pronged effect. There's a twofold reason why that might be the case. The first of which is that these stocks currently have a very low inherent return. These are stocks trading on 30, 40 times earnings. Essentially they're earning 2% of the value or 3% of the value of the business is earning each year. That relatively low current earnings becomes a lot less attractive as interest rates rise. If you view interest rates or the short-term federal funds rate as the risk-free rate, if the risk-free rate starts going up, low return assets start becoming less attractive. The second fold effect is that as interest rates are tightened, as interest rates are lifted and monetary policy is tightened, you're expecting lower future economic growth. You're expecting lower positive economic growth. And these are stocks that rely on that future economic growth. So if you're going to start tightening the economy and causing a reduction in growth, stocks that are predicated on that future growth become less attractive. So that's generally why we see growth stocks underperform during periods of monetary policy tightening. And it's why we generally see value stocks have a relative outperformance. So that's why, our core thesis for 2022 is that we'll see value stocks outperform. That's what happened in 2016. You can see that for the next sort of 15 months, really, value stocks started outperforming, or value stocks did outperform growth stocks. And then as the tightening cycle came to an end, growth stocks started outperforming again. So, if you follow the exact same blueprint, you have to assume that value stocks will be the place to go for the next 12 months. We're actually going to go a bit further than that, but I just wanted to highlight to people that, the sort of pipe dream stocks, the stocks that are traded on future potential, the stocks that really rely on, a lot of stuff being realized in future are not going to be the stocks that do well in 2022. Oops. Apologies. So this is the purple line down the bottom here. It's now changed to green. Apologies about that. But this is the US value index. And we know that it outperformed the US growth index for the sort of first 15 months of rate rises. However, I've now put a new chart in. This is a new chart, and this is obviously a bar chart of the Australian Materials Index. So our Materials Index had extreme and dramatic outperformance during the last tightening cycle. From 2016 to 2018, our Materials Index returned over 70%, which was vastly in excess of, the average value stock, vastly in excess of the average growth stock. Now, our Materials Index is made up of value stocks. It's made up of stocks that trade at, very, very attractive inherent values relative to their share price. These are stocks that trade at low earnings multiples, high dividend yields, high returns. And, history shows us that during the last monetary policy tightening cycle, these were the stocks that performed well. So this is a lot of what we're focusing our investment searching on for 2022. With our Emerald Equities platform, we've got quite a few material stocks out there at the moment. They're all doing quite well for us. We've taken a lot of nice profits on a lot of material stocks, and the material space is one that we actually predict will do very, very well this year. So if you take one thing away, a return to value, and potentially that means a bit of love for the material space. Now, will this time be the same as last time for our materials index? Well, if you look at the commodity prices, what our material stocks largely profit from, you can see that basically they're trading at very, very high levels. I've stolen this chart from the Reserve Bank of Australia, so thank you very much to them for that one. But they keep a very good index of commodities prices, and if you have a look, these prices are basically trading at all-time highs on a nice uptrend, and they're performing very, very well at the moment. So that further plays into our thesis that material stocks are stocks to look at in 2022. Oh, apologies, gone too far. All right. So that's what we're focusing on now. We've got a lot of recommendations on material stocks, and those are a lot of the stocks that we're looking at. Now, I just want to run quickly through our Emerald Equities platform, and I want to sort of give you a very, very brief analogy of how we came up with one of our more recently closed recommendations. I'm not going to show you a reco on the materials space. I'm not going to show you one that we've got open. You're going to have to speak to us for more information if you want information like that. But I will run through one of our recently closed recommendations. I'll tell you our thesis behind it, and I'll show you sort of how we came up with it using our platform. Oops, apologies. You will just have to give me a moment. Sorry, guys. All right. Sorry about that. So basically, this is our Emerald Equities platform. Tim's going to run through it in a bit more detail, but I do just want to quickly show you, how you can use the screeners, to use your investment thesis to come up with an investment idea. So I've just gone to the stock screeners menu and picked the Emerald Store screener for Australia. So one of our more recent theses last year was actually going into the end of year, going into the reopening period, and going into the Christmas period. The market was talking about monetary policy tightening, a tightening cycle. They were talking about lifts in interest rates, and we definitely heard that, and we definitely focused on value stocks. But we also thought that there was inherent value in some retailing stocks. These were stocks that got very, very negatively dealt with in many cases during the COVID pandemic. The market didn't respect their ability to generate earnings online. The market didn't respect their ability to get foot traffic once places reopened. And we saw a lot of inherent value in retailing, especially going into the Christmas period. So I'm going to sort of touch on, a retailing stock we were looking at. Started looking in September, late in September, and I think we went out with it right at the start of October. So we focused on retailing, and we came to our screener here, and we basically selected retailing. We went into a fairly complex, screening, but essentially, you can do something as simple as sorting by earnings, sorting by different factors. And we came up with a stock that had a fantastic earnings score, had a pretty attractive Emerald total score, but at the time it had a very, very low price momentum score. And that was JB Hi-Fi. So these scores here are basically our mathematical models that look through the financial data of a business and rank them out of 100 compared to their peers on the market, 100 being the highest. Essentially we came up with JB Hi-Fi. I've just clicked on it here as a recommendation going into the end of the year, going into the Christmas period. The key reason for this was because it was representing fantastic value, relative to its share price. We came up with that because it had a really attractive earnings score, had a really attractive quality score. In fact, all of its scores when we entered were extremely attractive except for one, and that was the price momentum score. And that was a really, easy way of us determining a stock that was potentially trading at a price below its inherent value. So we watched it for September, and then at the start of October, we actually noticed something, and that was if you charted our Emerald score, which is this orange line here, the Emerald score had started pushing up. Meanwhile, the share price, which is this blue line here, had actually stayed down. And that disconnect was really the signal that we used to decide this is when we put it out as a stock recommendation. Now's the go time. The financial data is picking up for this business, but the share price is continuing to head a bit lower. And that was really a fantastic signal for us. So we got in, the Emerald score at the time was 72, and that was because the price momentum score was almost 0. All the other scores were extremely good. We put out a recommendation on JB Hi-Fi. It was a value recommendation. It fit our investment thesis of a retailing stock going into the end of the year. And we put it out. We got in the low $40 levels. It says $45 here. I think we got a little bit better in terms of share price. And we got out yesterday. Was it yesterday or the day before? Just after their report, because that value was realized. So we took about a 19% profit in a couple of months. It really sort of highlighted to us, there is money to be made in this market, focusing on value and looking for a discrepancy between inherent value and price. That was a value stock we did. We're focusing a bit more on the materials space now. And again, we're using the screeners, we're using our scoring. Obviously, we're going to do a bit more of a deep dive into the financial data of a business, but that's a basic way that we come up with shortlists for investment targets. All right, so that was my thesis on value going into 2022. I will hand it back to my colleague Tim, who's going to run through a few more of the features of the platform. But yeah, thanks for giving me your attention for that one, guys. Cheers.
Fantastic. Thanks for that, Sammy. Okay, guys. So look, in front of you here is basically our research portal. Okay, so this is one of the main things we do on the Emerald side. I'll start here and then I'll talk through a few things. But basically, what our subscription involves, guys, is pretty much everything you're going to need to analyze companies. Okay, we cover the US and Australian. Okay, so we've got about 2,000 stocks for Australia and about 5,000 of the top stocks in the US. Okay, so you can make it as simple or as complicated as you want with our subscription. Okay, if you are quite experienced in fundamental analysis, you've got all your fundamental data here. You've got your balance sheet information, you've got sector analysis, you've got all your key ratio information, all that sort of thing. Or you can simplify it right down. Depending on your knowledge, okay? And simply use our scoring system. So our scoring system, we've got two systems. One runs for the Australian stocks and one runs for the US stocks. So they're slightly different, okay? So we have adjusted those scores for each market, okay? And we score against different things like growth, earnings. Basically, we're doing what our quantitative scoring does is takes the grunt work out of looking at the fundamental numbers. So if a score is, if a stock is scoring high, like JB Hi-Fi, it means that it is looking very strong from all of those elements compared to its peers. Okay, so it is measuring against its peers, and when I say peers, we're talking usually mid-cap. Okay, so we measure against other mid-cap stocks that, all right, what's their growth looking like? What's their forward estimate data looking like? What's their forward earnings estimates looking like? How far away are they from their price targets? How cheap or expensive are they from a price to earnings point of view compared to their peers? We're doing all of that work behind the scenes for you and then comparing against all the other mid-cap stocks. Okay, so then all you need to do is jump into the screener and go, okay, well, what scores highly from an Emerald score point of view? But then also you can dig a little bit deeper. What's more important to you? Okay, you might want to look for something that has a pretty high score but has a low price momentum. So it's been hammered down for whatever reason, but all the other forward data still looks really strong. You can get creative with how you use this scoring, but the most simplest way is what Sam just showed you, right? You just jump in, use the screener, you can select a sector, you can have all sectors in here, you can compare against the whole market, you can compare against just mid-cap stocks. What gives me my highest score out of the mid-cap stocks, okay? And, out of retailing right now, Harvey Norman's, stacking up really, really well from a mid-cap point of view. Sandfire, which is a stock that we talk about quite a lot in here, is scoring extremely high in the mid-cap space. That might be something you'd go have a look at. Now, we don't just jump in based on these scorings, okay? Obviously, there's other analysis that we like to do, right? We've got to do our qualitative analysis as well. We've got to look at the company, look at the sector. There's other things we look at. But what this does, we go, okay, well, between the US and Australian market, there is, 10,000 stocks. How do I screen that down to a bunch of stocks that I'm interested in? And this is the quickest and easiest way of doing it, okay? These scorings get updated every single day, all right? So we run our quantitative formulas across all of these stocks every single morning and upload that data into the website. So it is always refreshed and up to date. Where this stands out and is a bit different to other companies that do similar types of scorings, guys, is it is unique to the Australian market. A lot of these scores have been designed around the US market, and then they're just throwing the Aussie data in, okay? Our scoring was designed for the Australian market, and then we've gone out and adapted that data to work on the US market, okay? And that's one of the biggest points of difference from a scoring that we do compared to a lot of our other people out there. All right, so that's one element of this whole subscription, okay? In that alone, I think that's got a lot of value, okay, in that screener, in those scorings. And obviously what you can do is once you've found a stock that you like from a scoring point of view, you can drill in closer and closer and closer. All right, so I've mentioned all the sort of other data and things that come with it. You get analyst research notes from our analysts. And then the other big thing is our recommendations. Okay, so Sam did mention that before, and I'll just bring up the presentation again, guys. Just give me a moment. And basically, what you've got up in front of you here is all of our closed recommendations. Okay, so what you can see is our performance since 2020 when we started this, and this is just the Australian. Okay, we've also got US recommendations that we've closed off here as well. I'm not going to show you our open recommendations, obviously. Okay, I'm trying to entice you guys to pay for that, right? So I'm not going to give away everything we're doing at the moment, all right? But basically, if you have a look here, as our performance has been quite well, right? Now, if you were to put $5,000 on each one of these recommendations, you would have made up to about $16,800, okay? Or 34% on a 50K outlay. Now, obviously, guys, past performance doesn't guarantee future performance. We all know that. I've got to put that disclaimer in there, right? But, you know, our performance is quite good. Now, the way we do recommendations is very, very different to your typical UBS or big financial institution that put recommendations on every single stock that's on the market, okay? Or they have a very large covering of stocks. We don't do things that way. Okay, what we do is we sift and filter through the market and look for stocks that we believe are going to outperform. Okay, so it's a slightly different way of going about it. Okay, we want to be a little bit more unique. We didn't want to just come up with a service that's the same as what everyone else is doing. Okay, so all of our recommendations are stocks that we have a strong fundamental outlook on. They're generally in areas of the market that we believe will outperform in the coming years or months. Sometimes we're a little bit shorter term in our view. Sometimes we're a bit longer term in our view. Okay, but you know, generally a couple of months to a few years is our time frame we're looking at. Okay, you know, one thing I'll sort of say here, for instance, like a good example on how we do things is that you know, we still have Fortescue in our portfolio right now. That's one of our stocks we recommended. It's one of our first that we recommended actually a couple of years ago. And Fortescue's gone way above our price target of where we originally thought it was going to go. But we've decided to stay in, okay? So whilst a lot of other companies have put sell recommendations on Fortescue over the last year, and yes, Fortescue did fall a bit with iron ore, we've actually held in there, guys. Why? Because when we look at the dividend, you've still made the same as whether you got out and took profit. And we believe that the dividend is going to remain fairly decent, although, yes, it has to come down at some point with iron ore, and we knew that. But we stayed in because the dividend's really strong. It's a good value stock. It's still very, very cheap compared to where iron ore is trading right now. And we still have a belief that iron ore is going to rise in the coming year or two, okay? So, you know, we do things a little bit differently, okay? Now, how we show you what our view is we've come up with a traffic light system. And when you come into our website for the very first time, you're going to see a list of trades that we've still got open, okay? Some of them are doing extremely well. Some of them a little bit in the red. Now, the thing is, guys, you could have 50 years of market experience and still not get the timing on every trade correct. Okay, none of us are perfect with timing. In the short term, does it really matter, right? The reason why we're getting into these stocks is because we're fundamentally bullish. We've done our research and we feel that there's a lot of value that the market's not seeing right now. Okay, and that's the big skill set that a lot of people need to develop over years and years and years of interacting with markets. Okay. I laugh all the time, guys. So many people out there that go, oh, yeah, markets are simple. You buy low and sell high, right? For any novice, that seems simple, doesn't it? Okay, but we all know the markets aren't that simple. And in the long term, the stocks will always come back to their fundamentals, right? They'll always come back there. But in the short term, we've got things like, you know, the Russia-Ukraine situation right now is creating a bit of volatility. We had a huge pullback in markets through January on the back of everyone shifting their views on interest rates and getting a bit scared around how quickly the Fed might put the brakes on stimulus. And that shot the market down quite a bit, especially in the US. So we know in the short term, markets can be really, really knee-jerky, right? Where the skill is, guys, I believe, it's not always on entry. It's knowing which ones to hold and which ones to close, okay? That's the big thing here, and we show you that through our traffic light system. So we have green, and green means that you continue to buy that stock. We believe it's still cheap. The valuations are good. We check the fundamentals, and we look at these stocks on a daily basis, and we adjust the traffic lights on a daily basis, right? So if the stock goes from green, right, which is buy, we're still comfortable with buying at current levels. If it goes to yellow, it means hold off for a little bit, guys. Wait before you enter this stock. Something has happened here. Might have gone a bit too high. It's looking a little bit more expensive now, or we're waiting for a key bit of news to come up and we're a bit unsure how that news is going to go. So we're waiting for the news before you get buy any more of that stock. Okay, then if it goes red, it means we're saying do not enter this stock at all. We are looking for a potential opportunity to close. And that potential opportunity might be that it's getting very close to our price target. And at that price target, we feel it's getting a bit expensive. We're seeing the stocks on an upward momentum, and we're just going to wait for it to find some resistance before we recommend a sell. Okay, or the stock might have fallen off into lost territory for a little bit, but our fundamental view hasn't changed. Well, in that case, it's green still. Okay, so only time that I guess if the stock's fallen, it'd be a red light, would be that we still, our fundamental view might have changed a bit. We don't want you to buy it, but we think there's going to be a better price to get out at in the next few weeks. Okay, so there's a lot of short-term thought put into the timing of the entries and exits of these recommendations. Whereas a lot of our competitors and how they do things out there, your bigger financial institutions that are putting recommendations on a bunch of stocks, they generally only update you quarterly. Okay, so they'll put out their updates of their view on a stock after the company's reported. They'll wait for the next quarterly report, then they'll update their view. Or if something big happens, they'll go in and update their view. We look at this every single day, right? We're looking at our list of stocks, which is a much smaller list of stocks than these bigger guys, and we're really just finessing when we feel the best timing is, okay? And we feel that's going to help us give a bit of an outperformance of the market, and that's what we're aiming for, okay? We are here to try and outperform. We don't want to just match the market. You can go buy an ETF to match the market. That's easily done, right? What we're here to do is try and find stocks that are likely to outperform the market. Sometimes they're in the small cap space. They can get quite volatile, right? So, if you do get involved in our types of recommendations, don't just blindly get into everything, okay? Have a look at the stock. You've got to put a thought process into what suits your personal circumstances. We're recommending this out to everybody. There might be some stocks in there that are too risky for your appetite. You might be close to retirement, all that sort of stuff. You need to bring your personal circumstances into it, right? We're giving you a bunch of stocks that we really like, okay? We think they're going to outperform. You need to do a little bit of risk analysis. Make sure you stay somewhat diversified in your portfolio before you put them in, okay? But look, this is just, that's our main point of difference here, guys, okay? We don't just go, hey, we think this stock's a buy and ignore it for 3 months. Like JB Hi-Fi, we jumped in, okay, late September, and we got out early Feb. Very short period of time. And there was only, there was a small opportune moment where we thought, okay, we don't think the stock's likely to shoot up much further. Let's take profit now, just in case it decides to pull back. A lot of the other guys aren't doing that, right? They'll wait for the next report, do a bit more fundamentals, and then get out. Where we're doing a bit more sort of daily work on this, okay? So look, I guess where I'm coming from here, guys, overall, is I guess our main value prop to you guys, the customer, if you're interested in this sort of thing, is the scoring, okay? That's very unique to us. It's being built by us, and we spent I think a good 6 months in development doing that. So we believe in that scoring. We use that scoring ourselves to help us with our investment decisions in our portfolios, and I even use it from a trading perspective as well. If I'm trying to work out what stock I want to trade, BHP or Fortescue, I jump on and have a look at which one's scoring better, right? Because it gives me automatically, in one click of a button, which stock is looking better from a numbers point of view, right? So, you know, that's sort of the idea. Now, guys, shoot some questions into the QA box. If you've got any questions about this, please start shooting them in now, and I'll answer them as I go through. Now, just so you know the price point of what we're doing here, guys, okay, we're charging $82.50 a month. If you want to pay monthly, no lock-in contracts or anything like that. If you want to pay upfront for a full year, you'll get a discount, and that brings it down to $74 a month. Okay, so we're very competitive in what we do. We're very unique in what we do, and I believe we're very competitive in price as well. Okay, we're not the same as those $10 subscriptions you see out there, guys. You're going to get daily emails. You're going to get a lot of information, newsletter type information from us. We do a morning view, at midday, afternoon view. You're going to get all that emailed across to you, in addition to all the fundamental analysis we've shown you tonight, our scoring and our recommendations. Now, for a very limited time, and you know, you've got a couple of weeks to take advantage of this, what we're doing is trying to create awareness, and we don't offer a free version of this website, okay? Because as soon as you log in, you're going to see everything, right? So we don't give it away for free, guys, because you'll see everything we're in right now. You can just grab that information and, you know, you take our massive value prop and walk off, right? So we don't do that, right? What we want to do is entice people to come in and have a look. Okay, and what we're doing there, and this is for a limited time, just to the end of February, if you use the code when you go to sign up for the subscription, you're going to get 50% off for your first 6 months. And you can do that either by, you know, through the per monthly, and you can cancel anytime. We're not going to lock you in, right? Or you can pay for the full year and get that for half price as well. Okay, so, you know, up to you, right? You can sit down and work the math out to what best suits you. But if you want to subscribe, it's pretty easy. You just jump across to emeraldequities.com.au, and I'll show you that real quickly now. Okay, just scroll down to choose subscription, and you just basically subscribe, and you can enter that coupon here, and it'll apply the discount straight away. Okay, it's as simple as that to sign up, guys. You'll get an email straight away with your login details, and you can just jump in and have a go. You know, a few things I may not have really, you know, mentioned along the way here is Sam does a Thursday webcast every single week. Okay, in that Thursday webcast, he runs through, you know, what his view of the market is, right? So how he was talking tonight about value stocks, he's going to talk about themes, and themes in the market can change on a weekly, fortnightly, monthly basis, and he's going to help you keep up to date with the themes of what's going on in the market. That's priceless, guys. You get to ask questions. If you want a question about one of our open recommendations, you can ask that question there. It's an open forum to ask whatever you want about the market. It's a very good learning tool for people coming through. Okay, and we run that at 12 o'clock every Thursday. It's recorded. We also invite you to send emails into our advisors here, that sort of thing, if you remember, if you've got questions about one of our recommendations or something like that. All right, so it is a support forum. There is 6 of us here, advisors on the desk, looking at this on a daily basis, putting ideas out and recommendations out. All right, so probably the last thing I'll mention, guys, as well, is that we also, and I'll just put this back up again so you can see the coupon, right? Feb 22, it's pretty easy to remember that code, okay, Feb 22. One last thing I'll mention, we also offer trading services, okay? So we do US and Australian trading. I know there's a lot of people out there doing this at the moment, but something you want to have a look at when you do jump into our website and have a look around is our trading page. And that's going to show you our pricing. The big thing, the difference, that our point of difference, okay, to everybody else out there, is that we do not charge for currency conversion at all. You pay a little bit of spread, okay, whatever the difference is between the bid and the ask. Every other company out there in Australia doing US trading is going to charge you some form of currency conversion fee, usually 60 to 80 bips, okay? What that equates to, okay, if you're putting 50 or 100 grand over, is a lot of money. It's a lot more than what you're going to pay if you're trading US with us, is a couple of dollars a trade, okay? So when you run the maths, and I've done this in other webcasts, you'd have to do, if you did a 50K transfer over, that it's going to equate to about 40 trades, guys, by the time you even cover that one transfer of AUD to USD. Okay, so have a look at our pricing, guys. There is a currency conversion calculator on our website. All right, go have a look at it and see how much you're paying in currency conversions when you're trading US. All right. All right, so I think that's probably it from me, guys. Okay, thanks for listening in tonight. I think you got great value out of Sam and what he was talking about the value space in our market right now. We are all very excited to, get a bit more of our portfolio across to value at the moment. I know I've been adjusting since last year, getting a bit out of the tech and high growth space and moving slowly towards that value space myself. So, yeah.
Absolutely.
All right, I'll leave you there. Thanks for tuning in, guys. Have a great night, and I'll catch you on the next webcast.
Thanks, guys. Have a good evening.
All right, take care. Bye for now.